Today we're going to talk about tax depreciation. It's a question that I think that most physicians love to ask about. So I figured it would be a good segment for talking about passive real estate. If you have any questions, please feel free to put it into the chat. So let's talk first overall about the tax implications of passive real estate, and then we'll talk about depreciation in general, right? So typically when you talk about taxes, you get taxed on your returns, right? So there are a couple different ways that you will get taxed. So there's something called long-term capital gains. And you pay this when you own something for more than a year. So you have to own it for more than a year. So Sunrise on Chandler, for example, we're going to own for 5 years. So what you do is you pay taxes on the difference of what you paid for it. So say you bought something for $10 and then you sell it for $20. You're going to pay taxes on that $10 increase in value, right? So the difference. And what you'll pay is you'll pay 20% of the difference. So on this example, you'll pay about $2, right? So you get your first $10 back. Then you get another $10 of return, but you pay $2 of taxes on it, right? So you end up with $18 or 180%, right? And that's actually pretty similar to Sunrise on Chandler when we expect a 1.8 to 2x return. However, when we say an equity multiple or a multiple of your return of 1.8 to 2, that's before taxes, right? Because everyone's tax situation is a little bit different. So we don't include taxes when we discuss that, right? Now, the other tax that you pay is called depreciation recapture, right? So what depreciation is, it's a paper loss. What it says is anytime you own a product, something physical, the government says that over time it's going to break down, right? So say I buy a car and 20 years in the future, that car that I bought for, let's say 50K, it's going to be worth a lot less than 50K. So if you look at my net worth, right, you can't say, oh yeah, Pranay, you bought this car for 50K 20 years ago. Your net worth is 50K because of that car, right? Or it's in addition to whatever else I own, it's 50K. No, the government says over every year, this this product is worth less and less. So it's different for different vehicles and different products. For commercial real estate, what they say is that over 27 and a half years, your whatever real estate you own will go from worth whatever you paid for it, right? Purchase price to zero. Okay. So you can say over this time, my property is worth becomes zero, right? And then we'll talk about some specialty things like cost segregation, bonus depreciation. So, but this is everyone. And actually, you have to take this. You have to use that paper loss. So if you have $1 million property, let me grab my calculator. $1 million property, right? 1 million. Yeah. $1 million, right? Divided by 27 and a half. That means every year I can write off $363.63, right? And I have to, because at the end, they're going to be like, hey, you know all that depreciation you took? Time to pay taxes on it, right? So it behooves me to take this, right? And now what happens if I don't make that much money, right? Say my property, say I'm doing renovations, say I only make, and this is negative, right? It's a negative paper loss, right? And say I only make 20,000, right? In terms of rental income. Now I have negative 16,363 and 63 cents. This carries over into the next year and so on, and it keeps carrying over, right? So this is actually why you don't pay taxes on your returns immediately, because the government says you have a paper loss from depreciation, depreciation, because you own a physical product, which is commercial real estate, right? CRE, that has a paper loss of, whatever 27 and a half divided by that is. Now, it's to get into the weeds a little bit, it's not your purchase price because land can't be depreciated. So let's say the property was 1.2 million, and then the property itself is worth a million and the land is worth 200,000, right? So this is pretty cool. So when do you actually go back and you pay this tax? You pay this tax when you sell the property, right? And it's called depreciation recapture. They recapture all the depreciation you took. But the cool thing is, if you're not paying this back until you sell the property, and Sunrise on Chandler, we're not selling for 5 years. 5 years old. That means all the monthly returns we give you are tax deferred until we sell the property, right? And then, so this is 20%. And this, what is this? This is 20 to 25%. So even at the highest tax bracket, you're actually not paying that much. Now, you can get into the weeds a little bit with bonus depreciation, cost segregation. Sometimes this number changes a little bit for the most part, right? And so once we get to this, once we sell the property, there's actually a couple things you can do to kick this can down, right? And the thing about taxes, we all got to pay, but the important thing is the longer you can go without paying taxes legally, okay? So legally, the more wealth you're able to create for you, yourself, and your family, and then eventually pay taxes, right? So there's a couple different things you can do to kick this can down the road. One is called 1031, where everyone together, so say all of us in Sunrise and Chandler, and we currently have 289 investors, so a pretty good chunk. We all decide together, well, a majority of us decide, we're like, yeah, we're going to take all of this money, right? We're buying it for 46 and a half, and then we're going to sell for, say, 80 million, right? We take all of this 80 million and we go and buy another property. So depreciation gets reset. That means on the new property, we have a whole 27 and a half more years to depreciate again, right? And then we get 1031 again, we get 1031 again. And that's how a lot of value is created. I actually know someone, another sponsor that's been doing it for 30 years. And they give an example of someone that started their initial investment of 60,000, 60, and now is worth over $2 million because they've done so many of these 1031 exchanges. Now, that was kind of in the heyday, right? Investing in the last 20 years when we had this huge bull market, but it is still very valuable, right? You can also get into another deal that has a ton of depreciation and you can offset some of it. You can't offset all of it, but you can offset some of it so that maybe this number goes down. And this depreciation recapture, you pay taxes on all the depreciation you use. So for example, right here, right, where I have 36,363, right, every year in negative, and I use 20,000. So say, for example, we just sold next year, I would pay depreciation recapture on this amount, right? Because I used it. I got to benefit from it, right? I didn't pay taxes on that, which I normally would, right? So it's taxes that you would have paid anyways, but you're able to do this for longer, right? And that's the name of the game. Be able to kick this can down the line. And remember, this money, right? These distributions you're able to use for tuition, for vacations, for really living your life. And that's 5 years specifically for Sunrise on Chandler to that you wouldn't have to pay taxes. Now, there's a couple other things that kind of complicate things, but in a sense that actually make things better for us real estate investors. And remember, the tax law was written by a bunch of people that own property, so it's very favorable. Let's keep that. So a bunch of people that were much smarter than me went to the government and said, "Hey, government, you say that we can depreciate to zero, right? In 27 and a half years, right? But what about all these other things in the property that depreciate quicker, right? Rugs, windows, right? All this stuff, furniture, right? You really expect me to keep a rug for 27 and a half years? No. So what people do is, and what we will do for Sunrise on Chandler is called a cost segregation. That means we will look up at all the individual things that are part of the property, and we'll be able to take a majority of that depreciation that would take 27 and a half years, and we get most of it in the first year, right? And because it carries over, the earlier I give it to you, the more you can do it for stuff. More you can use it for stuff. Maybe you can use it against your rental incomes, active rental income that you have. Maybe you can use it. Maybe you have passive gains elsewhere, like partnership income that you want depreciation against, right? So the more depreciation we give you, the earlier, the better, right? Because then you can decide on what to do with it. And if you can't do anything with it, it just sits there and it doesn't hurt you, right? So we do something called a cost segregation. So we get a majority of this 27 and a half years worth of depreciation in the first year. And the government decided that that wasn't good enough to stimulate real estate investing. So they did something called bonus depreciation. So they took this number, right? The number that you get into the first year, right? And they said, we're gonna give you extra just for fun, right? So 2 years ago, this was 100% extra. So you would get 2x. Last year, it was 80%. This year, it's 60%. So every year, it's dropping by 20%. There is some thought that they might go back up to 100% because real estate investment is really kind of falling off the cliff right now. And which is actually why we told you that this might be our last deal for the year. There's just not many opportunities out there. But right now, it's currently 60%. So specifically, let me give you an example. So for Sunrise, Chandler, we're expecting about 50% of your investment in the first year. So if you put in, let's say 100K, we expect to give you a negative loss of about 50K in the first year, right? And so if you look at the cash on cash, we're expecting 3.5 to 5.5%. So let's say 4%. So in the first year, if you put in 100,000, we expect a positive 4,000, right? So that means next year your depreciation will look negative 46,000. So couple good things about this, right? One, most people don't file state taxes when they have a large negative loss. I actually don't file taxes in any of the states that have negative losses. Now, I'm not a CPA, that's not a tax advice, but this is what my CPA and I have agreed upon. So that means state taxes, not a big deal until we sell the property in 5 years. And also because I have a large negative loss, I'm not paying regular taxes on that income either. I'm really not paying until there's a positive, and it's not going to be positive until we sell the property in 5 years. So this is what people really talk about, the tax benefits. Now, there is a very, very small percentage of people that are able to use this money against their income. Now, I can tell you, if you're practicing as a doctor, you're not one of those people. So you have to be working in real estate full time or have a spouse that's working full time. And even if you have someone that's doing that, you have to be very involved. You can't have passive real estate. You really have to be active, hands-on real estate. So unfortunately, this is not going to work against your salary unless you have a K1 that you have passive gains. So some people with partnerships, some people with real estate do have K1s, and for that, it's super powerful, right? For most of us that are still working in medicine, pharmacy, or dental, it doesn't help us that much unless you own your practice, because then it might actually help you a little bit. But tax free, tax deferred, can't say tax free because you're going to eventually get tax deferred returns. That's the real benefit. And if you if you keep doing these 1031s, which I don't know if we'll be able to do it for this deal. We'll be looking. However, and if the deal is, if we're going to sell it for 80 million, it's going to be hard to find a deal that large. And you have a lot of stipulations in terms of how quickly you can buy a property. You got to find it within 6 months, have it identified within 45 days. So it's pretty complicated. But when you have a lot of depreciation from elsewhere, you're able to decrease the amount of taxes you pay. So it's nice. It's money. So what I tell people, it's similar, right? It's similar to your your retirement accounts, except so you're not paying taxes on it. You're able to use that money now, which is way different than your retirement accounts. And then eventually you'll pay taxes on it. So kind of like a Roth, right? So the only downside is you're putting money into this as pre-tax. So there are other people, right, that will invest in a self-directed IRA, a solo 401k, and then something also called a checkbook LLC, which is also goes by EQRP. And with one of these three, you're able to invest in your retirement accounts. Now, not all self-directed IRAs, right? You got to have specific ones, and not all solo 401ks. So, but and if you need a list, of ones that we have worked with, let us know. But if you want to invest with your free tax money, it's possible to get into real estate as well. And then all of this stuff doesn't really matter too much, right? Because because you'll pay taxes on it at a later point. So the downside of that is that the money that comes out, right? These monthly distributions that we give, it goes back into your retirement account. So for a lot of people, it kind of negates the purpose of investing in real estate, because one of the big benefits is monthly paychecks, right? Monthly paychecks, tax deferred, use it for fun, right? So like us physicians, we're kings and queens of delayed gratification. So I actually like the fact that we have this money and that we can use it uh, for stuff that we want to do, as opposed to waiting till we're 65 to do that. Personally invest always in my own name, not in retirement accounts for real estate. and my retirement accounts are all stock market. But really just depends on the individual person and kind of where you are in your life, right? If you're close to retirement account, if you're close to retirement age, it might actually make sense to use pre-tax money because you're going to have access to your 401k in the relatively close future. So it just kind of depends on where you are. So that's kind of it. Let me think about anything else that we can talk about in terms of taxes. So the big thing is that it doesn't increase your tax burden, which most things are. Oh, the other big thing, a lot of people like to compare this to stocks. What I would look at this as is a dividend stock, so like a Coca-Cola or an Apple or something that has high dividends. The problem with dividend stocks is that they are taxed at your marginal rate, right? So not 20 to 25%, right? They are taxed immediately at your marginal rate, right? So as soon as you get the dividend, you get taxed at, 37, 38%. While this, not only is it much lower, but you don't get taxed on it right away. And similar to REITs, right? So dividend stocks and REITs are both the same, right? REITs are real estate investment trusts. They're actually somewhat similar to syndications, just a much larger scale. But they get treated like dividend stocks. So the returns you get are going to be taxed similar to a stock. And you don't get long-term capital gains on dividend stocks, or dividends are treated like interest. So like a debt fund, you get taxed at your marginal rate. So there's definitely a downside to that. Let me see if we got any questions. Okay. That's all I got for taxes. Uh, we are about 78% full in terms of Sunrise on Chandler. We're expecting a large check of 3.5 million and another one of a 1.5 million. So once we get those, we'll be very close to being full. And we're looking to close kind of July, sorry, early to mid June. So we're almost there. And so it's a great deal. Probably our last multifamily deal for the year, especially kind of given where we are with interest rates. I read an article today that said interest rates might go up. Who was it? I think it was the St. Louis Fed, right? So when the Fed, the people in charge of the Fed, when they say something, they're very careful with the language and the words they use. So when they drop hints that potentially interest rates may go up, it would make our, fixed loan even more valuable. So we all think that we are kind of headed towards interest rates being down, but who knows, right? And we started off the year with the betting market saying we're going to have 6 rate drops this year, and went down to 3, and now we're lucky if we get 1, and potentially have even an increase in rates for this year. So it's a, definitely volatile time, and that's why we are happy to be doing this deal right now. Fixed rate interest rate loan. We're expecting about a 14 to 16% IRR, and cash on cash of about 3.5 to 5.5%. So if anyone has any questions, feel free to jump on my calendar. I'm happy to chat about it. And if you want to talk about taxes, real estate, or anything else, please let me know. Chat soon. Bye.